72 hours. That is all it took. It took exactly 72 hours to take the most explosive rally in precious metals history and turn it into the single largest liquidation event that modern trading has ever witnessed. Tuesday, Thursday, Friday, 3 days, 3 moves, $10 trillion, gone. I want you to understand something before we go any further. What happened on Friday was not a crash. That word is too small, it's too ordinary, it's too comfortable. What happened on Friday was an execution. It was a controlled demolition of wealth so precise, so calculated, so perfectly timed, that when you see the full picture, you will never look at markets the same way again. Gold dropped 15%, silver dropped 40%, in 6 hours. Not 6 days, not 6 weeks, 6 hours. No war started that morning, no pandemic emerged, no bank collapsed, no breaking news, no emergency broadcast, nothing. Complete silence from every major news outlet. And yet, while that silence hung in the air, $10 trillion vanished from existence. Gone, as if it was never there. But here is what they did not tell you. On the same day, while your portfolio was bleeding, while traders were getting liquidated, while $10 trillion was being erased from screens around the world, something else was happening in Washington. The United States government was hours away from a complete shutdown, chaos on top of chaos, uncertainty on top of uncertainty. And right in the middle of it all, the largest single-day destruction of precious metals wealth in recorded history. You think that timing was coincidence? Keep watching. I know you're watching this because you are scared. Maybe you held gold. Maybe you held silver. Maybe you watched years of gains disappear in a single afternoon while the world gave you no explanation. They told you it was a correction. They told you markets got ahead of themselves. They told you this was healthy. I am going to tell you the truth. This was not healthy. This was not natural. This was not supply and demand finding equilibrium. This was a screenplay, written months in advance, rehearsed, perfected, and executed with the precision of a military operation across 72 hours. And today, I'm going to show you that screenplay, page by page, move by move, name by name. By the end of this video, you will know exactly who did this, exactly how they did it, exactly why they did it, and exactly why they have done the same thing twice before in the last 50 years. Stay with me, because what I am about to reveal will change how you see everything. Welcome to the hidden economy. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now because this is the kind of analysis you will not find anywhere else. And if you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see it. Let me take you back to Tuesday, January 27th, 2026, 3 days before the crash. President Trump is speaking. Most people are not paying attention. It is just another policy statement, background noise for the evening news. But then he says something, a single sentence that most of America missed completely. He says that a weaker dollar would benefit American businesses. He says America should do what China and Japan have been doing for decades. Devalue the currency, boost exports, make American goods cheaper for the world to buy. Now, to a normal person watching at home, this sounds like economics. Boring, abstract, nothing to worry about. But in trading rooms across New York, London, Hong Kong, and Singapore, phones started ringing because traders understood exactly what Trump just said. The President of the United States just announced that he wants a weak dollar. And when the dollar weakens, gold rises, silver rises, precious metals rise, because they are priced in dollars globally. A weak dollar means it takes more dollars to buy the same ounce of metal. Within hours, the trade was on. Hedge funds started shorting the dollar. Asset managers started loading up on gold. Retail traders started piling into silver. Billions of dollars moving in one direction, everyone betting on the same outcome. Weak dollar, strong metals. Tuesday was the day the trap was set, and nobody knew they were walking into it. Now let me take you to Thursday, January 29th. Gold hits $5,600 per ounce, the highest price in the history of human civilization. Silver breaks 121, all-time high. The numbers were beyond comprehension. Silver had gained 68% in January alone. That is the strongest monthly gain since December 1979. Nearly 50 years ago, social media was on fire. Every financial influencer was bullish. Analysts were calling for $200 silver, $300 silver. Some said $500 was inevitable. On Monday of that week, the iShares Silver Trust saw $171 million flow in from retail investors. $171 million in a single day. The largest single-day inflow in the history of that fund. Double the previous record set during the famous silver squeeze of 2021. The total silver market had grown to $6 trillion. Let me put that in perspective. That is larger than Nvidia, larger than Apple, larger than Alphabet. One analyst looked at the frenzy and called silver the meme commodity of 2026. Everyone was euphoric. Everyone was winning. Portfolios were up 50%, 100%, 200%. Thursday night, people went to sleep, dreaming of early retirement. And none of them knew that, while they slept, the execution order had already been signed. Most of America is still in bed. The markets have not opened yet. Coffee is brewing. Alarms are going off. And then, a headline. President Trump announces his pick for the next Federal Reserve chairman, Kevin Warsh. Now, if you are a normal person, that name means nothing to you. Just another suit, another bureaucrat, another face in Washington. But if you are a trader, if you understand how the Federal Reserve controls the entire financial system, that name just sent ice through your veins. Because Kevin Warsh is not just any economist. Kevin Warsh is what they call a hard money hawk, a man who has spent his entire career fighting against easy money, against low interest rates, against a weak dollar, the exact opposite of what Trump said on Tuesday. Do you see the contradiction? Tuesday, Trump signals weak dollar. Traders short the dollar and buy metals. Friday, Trump appoints a Fed chairman who believes in strong dollar. The same traders who shorted the dollar on Tuesday were now forced to buy it back on Friday. The same traders who bought metals on Tuesday were now forced to sell on Friday. Forced reversal, forced selling, forced liquidation. Tuesday and Friday, same president, opposite signals, 72 hours apart. That is not confusion. That is not a policy mistake. That is a trap that closed in 72 hours. But wait, there is more. Because even with the Warsh announcement, silver should have fallen maybe 15%, 20% at worst, a painful correction, but survivable. What actually happened was 40% destruction in a single session. How? Because there was a third player in this game, a player that nobody saw coming. China. Let me explain something about how precious metals markets work. When prices fall, usually there's a buyer waiting, someone who sees value, someone who steps in and says, at this price, I am buying. For precious metals, that buyer has always been China. They are the largest consumer of silver in the world. They use it for solar panels, electronics, electric vehicles. They have an insatiable appetite for the metal. Usually, when silver crashes, China steps in. They buy the dip. They provide liquidity. They put a floor under the price. Friday was different. At the exact moment when the market needed a buyer, at the exact moment when sellers were overwhelming the system, at the exact moment when liquidity was disappearing, China made a decision. They stopped buying. The Shanghai Exchange suddenly raised margin requirements. They stepped back and let the carnage unfold. Now think about this situation. American traders want to sell their gold and silver because Kevin Warsh signals strong dollar ahead. But the buyer who always catches falling metals, China, just walked away. Sellers everywhere, buyers nowhere. What happens in a market where everyone wants to sell and no one wants to buy? The price does not fall, the price collapses. And that is exactly what happened. The algorithm smelled blood. Stop losses started triggering. Margin calls went out across every brokerage in America. Traders who were up 100% last week were suddenly getting liquidation notices. And once the cascade started, nothing could stop it. Silver went from 121 to 115, then to 110. Then it broke below 100 for the first time in weeks. The psychological level that everyone said would hold forever. Gone in minutes. $75, $46 erased in 6 hours. The ProShares Ultra Silver ETF, ticker AGQ, crashed 60%. 60%. If you had $10,000 in that fund on Thursday night, you woke up with $4,000 on Friday afternoon. Gold fell from $5,600 to $4,700. $900 vanished per ounce. $3.4 trillion of gold value wiped out in a single session. The biggest single-day drop since 1980, 45 years. One trading desk called it a capitulation event. Another called it the largest single-day wealth destruction in precious metals history. $10 trillion. One session, gone. Now, here's where it gets really interesting. After the crash, I went through the data. Not the headlines, not the analysis, the actual trading data from the exchanges. And what I found changes everything. On Friday, 531 tons of silver contracts were traded in Shanghai. 531 tons. That sounds like a massive number. That sounds like real selling. That sounds like people dumping their silver. But here's what the data actually shows. Physical silver withdrawn from Shanghai vaults on Friday, 0. Let me say that again. 531 tons of silver contracts traded, 0 tons of physical silver moved, not a single gram of real silver left the vaults. So what actually happened? Paper, pure paper. Shorts needed an exit. They got one. They pressured the price down with empty paper contracts. They closed their positions at lower prices. And buyers absorbed everything at the bottom. This was not a crash. This was a position transfer. Shorts exiting, longs entering. paper changing hands while physical silver sat untouched in vaults. The screen showed chaos. The vaults showed nothing. Now let me show you a number that will make your head spin. On Friday, when comics closed, the paper price of silver was $84. On the same Friday, when Shanghai closed, the price of silver was $122. Same metal, same day. 44% difference. Let me make sure you understand what I just said. If you tried to buy silver on a screen in New York, the price was $84. If you tried to buy actual physical silver in Shanghai, the price was $122. If you went to Tokyo, physical silver was selling for $150. A 44% gap between paper and physical. On the same day, for the same metal. Which price is real? The paper price that can be manipulated with contracts backed by nothing, or the physical price where actual metal changes hands? Here's what they do not want you to think about. In the weeks before the crash, physical silver was selling for $120 to $150 at dealers around the world, and it was sold out. Dealers had no inventory. Demand was overwhelming supply. Now ask yourself a simple question. If you are a dealer, and customers are lining up to pay $150 for physical silver, and your inventory is sold out because demand is so high, why would you lower your price just because a screen in New York shows $84? You would not. The screen shows one number, reality shows another, and the gap between them is 44% and growing. But here is what really convinced me this was scripted. Remember when the crash happened? Friday, January 30th, the last trading day of January, month end. Now let me take you back exactly 1 month. December 31st, the last trading day of December, month end. What happened that day? Silver dropped 15% in one day. Same pattern, same timing, month end. And then what happened? Silver continued its rally in January, went to all-time highs. Now January 30th, the last trading day of January, month end. Silver drops 40%, 2 consecutive month ends, 2 massive drops, same pattern. Coincidence? Let me show you what else happened on those exact days. On December 31st, the Federal Reserve's standing repo facility handed out a record amount of dollars to banks. Record. The highest ever. And what was happening in Washington on January 30th while silver was crashing? The government was on the edge of shutdown. Congress scrambling. Chaos everywhere. Now here's the connection nobody's talking about. The banks that received those record repo dollars on December 31st, they are the same banks that hold massive short positions in silver. The data is public. You can see it on Fred. You can see it on CME. Anyone can verify this. Month end is when banks need to clean up their balance sheets. Month end is when they need to close positions. Month end is when they need liquidity. And month end, twice in a row, is exactly when silver mysteriously crashes. December 31st, repo record. Silver crashes 15%, then recovers. January 30th, government chaos. Silver crashes 40%. Same pattern, same timing, same players. This is not coincidence. This is a calendar, a script that runs on schedule. Now let me show you what the CME was doing behind the scenes while all this was happening. December 12th, 6 weeks before the crash, silver is rallying hard, making headlines. Regular people are making money, and quietly. Without any announcement, the CME raises margin requirements by 10%. Nobody notices. That was the point. December 29th, silver keeps climbing. CME raises margins again. 25% jump overnight, no warning. December 30th, less than 24 hours later, they raise margins again. 2 hikes in 2 days. January 28th, 3 days before the crash, CME changes the entire margin system. Fixed amounts become percentages. 9% becomes 11%. 4 margin hikes, 6 weeks. 80% increase in cash required to hold a position. Now let me tell you what that means for a normal trader. You bought silver at $60. You have been riding this rally for months. Your account is up big. Life is good. And then, without warning, your broker sends you a message. Your margin requirements have increased. You need 80% more cash in your account today, right now, or you get liquidated. Where does that cash come from? Most people do not have 80% extra just sitting around. So they get liquidated, forced to sell, whether they want to or not. And when thousands of leveraged traders are forced to sell at the exact same time, the price does not decline. The price collapses. But here is what should really disturb you. After Friday, after the crash, after $10 trillion vanished, the CME raised margins again, Saturday, the day after the massacre, another hike. Gold margins going from 6% to 8%. They raised margins before the crash to cause forced selling. Then they raised margins after the crash to prevent a recovery. If this was risk management, they would lower margins after volatility subsides. Let the market heal. Let traders recover. Instead, they increased pressure. They kept their boot on the neck. That is not protection. That is suppression. Now let me show you why this matters beyond Friday. This is not the first time they have run this script. Silver runs from $6 to $50, 800% gain. Regular people making fortunes. The Hunt brothers trying to corner the market. What happened? CME created Silver Rule 7, banned leveraged buying overnight. The Federal Reserve raised rates from 11% to 20% in a single move. Result? Silver crashed from 50 to 10, 80% destruction. Silver runs from $8 to $50, 600% gain. Retail traders everywhere, banks with massive short positions getting crushed. And what happened? CME raised margin requirements 5 times in 9 days, 84% increase. Result? Silver crashed from 50 to 26, 50% destruction. It took 13 years to recover. Now, 2026. Silver runs from 26 to 1 in 21, nearly 400% gain. The biggest rally in modern history. What happened? CME raises margins 4 times in 6 weeks. China raises margins and steps back. Fed chairman announcement timed to cause maximum reversal. Government on the edge of shutdown. Shorts get their exit through paper manipulation while physical sits untouched. Result? Silver crashes 40% in a single day. The fastest destruction of the 3. 2026. Same pattern, same tools, same timing, same destruction. 3 times in 50 years, every time silver threatens to break free. Every time regular people start making real wealth in precious metals. Every time gold and silver start exposing the weakness of paper money, the same script executes. Once is an accident. Twice is a coincidence. 3 times is policy. But here is what should make you furious. While paper prices were crashing, while retail traders were getting liquidated, while $10 trillion was being erased from screens around the world, guess what central banks were doing? Buying. Not selling. Buying. 800 tons of gold accumulated by central banks last year. The fastest pace in decades. The dollar's share of global reserves has dropped to 58%, lowest since 1995. For the first time in modern history, gold now represents a larger share of central bank reserves than U.S. Treasury bonds. Let that sink in. Central banks around the world now trust a metal more than they trust America's promise to pay. They crash the paper price, then they buy physical at the discount they just created. Retail sells in panic. Central banks accumulate in silence. It is the greatest wealth transfer in modern history. And it happens every time they run this script. And that brings me to the most important part of this video. I want to talk directly to you. I know you're scared right now. I know you watched your portfolio bleed. I know you're wondering if you should sell what is left and walk away. Let me tell you what I told people a few days ago. When silver was at 121 and everyone was euphoric. When everyone is greedy, be a little fearful. And now, when the market is drowning in fear and panic, logic says the opposite. When everyone is fearful, be a little greedy. That is not financial advice. That is not me telling you to buy or sell. That is just how markets have worked for centuries. Fear and greed, cycles that repeat. The people who panic sell at the bottom regret it. The people who buy when there is blood in the streets remember it as their best decision. Which one will you be? Here is the question I cannot stop asking myself. If gold and silver truly do not matter, if they are just relics of a past economy, if they have no place in the modern financial system, then why do they keep doing this? Why coordinate a Fed chairman announcement with a crash? Why have China stepped back at the exact moment liquidity was needed? Why raise margins 4 times before and once after? Why does the paper price show 84 while physical sells for 150? Why run the same script on the last trading day of December and the last trading day of January? Why does the standing repo hand out record dollars to the same banks that are short silver? Why spend so much effort suppressing something that supposedly does not matter? They say it is market forces. They say it is supply and demand. They say it is normal volatility. But $10 trillion do not vanish in 6 hours by accident. 531 tons of paper do not trade, while 0 physical moves by coincidence. 44% gaps between paper and physical do not appear in healthy markets. You do not fight this hard against something that does not matter. The intensity of the attack tells you the value of the target. They are not protecting the market. They are protecting the dollar, protecting the system, protecting the narrative that paper money works, and the fact that they keep running this script, the fact that they have done it 3 times in 50 years, the fact that they will do it again, tells you exactly what precious metals represent: a threat, a way out, real money that exists outside their control. That is why they attack it. That is why they crush it. That is why they will never stop trying to suppress it. Because if gold hits 10,000 and silver hits 300, what does that say about the dollar? What does that say about 50 years of money printing? What does that say about the entire system they have built? It says the paper has failed. It says the game is ending. It says everything they told you was a lie. That message cannot be allowed to spread. So they write scripts like this one: Tuesday, Thursday, Friday, 72 hours of controlled demolition. And they expect you to panic. They expect you to sell. They expect you to give up and walk away. But now, you know the script. You have seen the 72-hour timeline. You have seen Trump's contradicting signals. You have seen China's perfectly timed exit. You have seen the 531 tons of paper with zero physical movement. You have seen the 44% gap between screen price and real price. You have seen the month-end pattern. You have seen the standing repo connection. You have seen the margin hikes before and after. You have seen the same playbook executed across 50 years. It was scripted, every single piece. They called it a crash. I call it the third time in 50 years they told you exactly what they fear. They called it volatility. I call it a 72-hour execution. They called it risk management. I call it the system showing you its hand. And what they fear is simple. You, holding real metal, outside their system, beyond their control. Remember that 44% gap I showed you earlier? Paper at 84, physical at 1 in 50. That gap is not a glitch. That is the system telling you which price is real. Paper is just a promise, a number on a screen. Metal is real. It sits in vaults. It cannot be printed. It cannot be hacked. It cannot be margin called out of your safe. They can crash the paper price. They cannot crash the metal itself. They can liquidate your futures contracts. They cannot liquidate the silver bar sitting in your possession. 3 times in 50 years they have run this script. 3 times, silver eventually recovered and went higher than before. The question is not whether silver recovers. History says it will. The question is whether you will still be holding when it does. I started this video with 72 hours. Tuesday, Thursday, Friday. Now you have seen it all. The setup, the peak, the execution. It was scripted, written in advance, rehearsed over 6 weeks of margin hikes, timed with government chaos, executed with paper contracts while physical sat untouched, coordinated across continents with precision that would make military planners jealous. They called it a market event. I call it financial warfare. And I call it the clearest signal in 50 years of what they truly fear. Real money, in real hands, beyond their reach. Now you know the script. What you do with this information is entirely up to you. But remember this moment. Remember how you felt when you watched your portfolio bleed. Remember the fear. Remember the confusion. Remember how they gave you no explanation while $10 trillion vanished. And remember that you now know something most people will never understand. It was scripted. If this video helped you see what really happened, send it to one person who needs to see it. One person who panicked on Friday. One person who was thinking about selling at the bottom. One person who deserves to know the truth before they make a decision they will regret. That is how we fight back. Information, understanding, truth? Drop a comment below. Tell me, after everything you have seen today, are you holding or are you selling? I read every single one. Subscribe if you want to keep seeing what they do not want you to see. This is the hidden economy. The script is exposed. Now write your own ending.